Associations. David Sturken, partner at Maitland AMO, will moderate. David.
Good morning, all. We're here to talk about the DACH region, and we're very happy that you're all sitting here to listen to us. And we have 4 panelists who are going to introduce themselves. Oksana, you want to start?
Oksana Tiet, I run the private equity side of Lennartz & Co., which is a multifamily office based in Hamburg. We invest in funds, we do our own deals, we do co-investments with the funds we are lucky to invest with, and we invest in private equity, venture, European venture, American venture, US venture, and blockchain venture.
Anja Jegen, Hellebar Invest. I'm heading the private equity and direct lending space at the asset manager in Frankfurt. We cover all illiquid asset classes from real estate infrastructure, and I'm doing the private equity and direct lending space and covering everything, direct investment, fund investments, advising institutional clients for private equity globally and in Germany.
Hello, Mara Stock. I'm an investment director at Capiton. Capiton is a mid-market GP located in Berlin. We are only investing in mid-market firms in the DACH region and primarily in the sectors healthcare and technology.
Yes, and my name is Markus. I represent Odo BHF, which is a Franco-German-Swiss financial institution, essentially with 3 areas of activity: private wealth management, broadly 55 billion, institutional asset management, broadly 60 billion, and banking activities in between. And within asset management, a couple of years back, we've launched private assets. So we're over and above 3 billion for private assets, mainly private equity. We're starting venture capital. And I represent private debt, which initially obviously was done by BHF Bank, which is part of the group, which we took essentially out of the banking business a good 4 years ago, and we now run it as private debt and fund structures, mainly focusing on the German mid-market.
Thank you, Markus. First question is to Anja. What do you think is attractive about the DACH region?
I thought it's good to have an overview how much private equity is done in Europe and what are the main countries. So just in one sentence, in 2021, there were about 750 private equity transactions in the UK, about 580 in France, and about 530 in Germany. So Germany is the 3rd biggest market in Europe doing private equity, but I think of the 3, the least established one, because it's still dominated by the German Mittelstand, which is, I think, very special in Europe and shows us a different kind of entrepreneurship and value of companies. I would say that's the main distinguishment we will talk about when we talk about the German market and the German Mittelstand.
Thank you, Anja. Oksana, anything to add?
Sure. I think if we look kind of on the macro level, right, Germany actually has everything to make a very successful private equity market. So we have the labor force that is educated enough to run businesses. We have management teams and enough of them. We do have somehow an acceptance of private equity as an alternative asset class. We do have a plethora of companies. Of course, we have healthy financial institutions. So it should be a very attractive market. But of course, we're sitting here in the spring, in the fall of a very unusual year with a lot of uncertainties. So because we, of course, invest in early stage and growth and in very mature PE, we always look at it a little bit more nuanced. And we do expect, a lot of activity in kind of the early stage and the growth, addressing the issues that are on the front pages of the newspapers. And we do expect private equity to some extent, again, recreating itself like in the last cycle and working differently with more established companies.
Thank you. Next question for Mara and Markus. What kind of deals and investment strategies are you seeing right now? How is that different to pre-COVID? And what do you think is the outlook given Germany's special situation at the moment?
So we do a certain we do see a certain bifurcation of the market. So we continue to see deal flow from strong performing companies that are active in less cyclical markets, especially in the healthcare or also in the technology space. We do see the deal flow primarily from entrepreneurs, family owners, so definitely less secondary deals in the market, and in general, a much lower space. On the other side, you probably will not sell a retail company directly linked to consumer spending currently for attractive pricing. So we continue to do deals. We have already closed 3 deals this year, all in more defense industries and all with, I think, more conservative also structures in terms of debt. But as it's also always part of our investment strategy, that's something we did not change or had to adapt.
Yeah, I mean, quite clearly, a lot of our activity is to support private equity funds, so that actually can only mirror what Mara said. But essentially, for us, I mean, lending obviously goes over and above that, and we expect, especially in the next 12 to 18 months, a lot of short-term financing need. Because, I mean, good companies will try to maximize pre-stocking for critical components to avoid further increase in prices and to avoid, obviously, shortage of key components, and that needs to be financed. And I would think that traditional banks will come to their limits because mainly they have a very industrial portfolio compared to funds, so they will be very busy with their existing portfolio. And we expect more sponsorless deals to come to the market for the private debt world. It has been a very low percentage, but given that banks will no longer be able to increase the working capital lines and so on, I think there will be opportunities for funds opening up. And obviously we see, for us, more conservative structures and very defensive sectors. I mean, IT, software, hardware, service, healthcare, business services, education. I mean, those are the themes that have been looked after already in the past, and I think this will accelerate. So anything that is industrial, which we've obviously seen quite a bit before COVID, will take a long time to recover, except for this sort of short-term bridge financing and emergency financing needs that will arise.
Thank you, Markus. Let's talk about the backbone of German industry, the Mittelstand. Oksana, why do you think PE is attractive for Mittelstand sellers, and what other buyers would Mittelstand find attractive apart from PE?
Yeah, I think this is this topic that we've been discussing for years, right? Everyone is waiting for this wave of Mittelstand eventually accepting private equity and selling. I think we haven't really seen it in the large buyout space, some, of course, but we do see it a lot in mid and small funds. And I think this this deal flow will only increase because, of course, you know, you look at the macro, why would anyone sell right now? Valuations are depressed. But they just have different reasons to sell. Sometimes, you know, the owners are just tired. Last few years were not kind on them. Sometimes they really need assistance, right? They need to grow, they need to do M&A, they need to professionalize. So those reasons are usually not really correlated to the macro side. And we see these deals in different shapes, in different forms, and we also, you know, we as a multifamily office, we also play there to some extent, and we see other family offices doing deals. And of course, you know, we're not going to compete with Capital, for example, in this space, but we do have very patient capital, and we sometimes understand what owners need after they sell in ways that, you know, private equity cannot help. But the playbook we use is to some extent similar. So we also assist in operational improvements, we assist in M&A, we assist in internationalization, and we'll expect that to actually continue and increase. So any small and mid-sized funds in Germany should see abundant deal flow and actually serve Mittelstand very well with the playbook.
Thank you. Anja, any thoughts?
I would focus on the point that Germany is really dominated by small and mid-cap companies that are the employment and economic engine of Germany, and a great supporter for a German global players. So they are the suppliers of global players, and they are quite innovative. And I would like to look at the environment right now, that the company financing is still dominated by banks, but banks face problems, so they need new financing. Some can go and get financing from debt providers, some need equity, and that's why private equity in Germany is really something attractive and will give us good returns in the future. And I'm very positive that the German economy, especially the small companies with good business models, will go over the crisis and will be profitable in the future again.
Thank you, Anja. Let's talk about ESG. Marcus and Mara, where do you think the Germans are in terms of that? And what about impact investing? Is that something that you see a lot?
So I think Germany improved significantly on the terms of ESG. So especially in the GP industry, ESG is by now an integral part in all kinds of levers, being it deal selection, portfolio management, but also for every GP by itself. So, of course, we have also implemented this in our investment strategy and in our portfolio management approach. And also for us as a firm, we set ourselves certain targets that we want to achieve in terms of increasing diversity in the team, in terms of offsetting carbon footprint, etc. So it is present. And we see that also in Germany, everybody's either discussing or has already implemented certain ESG guidelines according to SFDR 8. And we are also now looking at what to do to get closer to SFDR 9, where we see the overall market is also moving. So ESG has moved in Germany from being probably a couple of years ago a unique strategy to be an absolute must everywhere, not only for GPs, of course, LPs, but also in the entire German economy. And the primarily driver for this is that probably everybody is aware that we all want to live in a better, more sustainable world and that we have to do something for it. And the private equity industry, having in Germany, especially in the Mittelstand, a significant amount of PE-backed firms, we do have the responsibility and the chance to improve the ESG situation across the industry. And of course, a private equity industry, especially GP, needs to lead by example and show how to do it and make sure that the portfolio companies of them will follow it.
Marcus?
Yeah, from our perspective, fully agree with what Mara said. I mean, we as a group have been focusing on ESG obviously for a very long time. We're a UN PRI signatory for the last 12 years, whereas we see that a lot of GPs are getting to that stage as we speak. And we've been actually transferring our funds, which have been in existence already before SFDR came into place. We've translated them into an Article 8 classification pretty much on the go. I think the importance is there for the financial industry. Maybe sort of 2 points to mention in addition what Mara has said. First, we see that in particular LPs from the Nordics and from France are very much at the forefront of ESG demand. I mean, in France, for example, there's regulatory requirements for LPs to report on their investments with ESG criteria that have been in place before the SFDR classification came on board. The Germans are catching up, but they still need a bit of time to get to that level of awareness that we see in France and particularly in the Nordics. And the second point is obviously who definitely needs to catch up the most is the mid-cap company. So already for an Article 8 fund, not speaking about Article 9, the challenge is in the availability of data because, I mean, you can calculate a CO2 footprint from an external source with support of external providers, but for energy consumption and other, you need in-house data from the company. And we're seeing that as we're launching that with really small mid-cap companies now as an Article 8 fund, that the challenge is quite clearly there because they're not well equipped, they don't have particular people with that knowledge, and they don't have the right systems. And I think that's the biggest catch-up to be made, the mid-cap companies. And they are willing to go down that route, and obviously EU Commission and so on want to bring the Mittelstand to that level over and above the financial industry. But the financial industry is quite clearly well ahead of the mid-cap companies in that respect, which is a challenge mainly to reporting.
Thank you, Marcus. And you're talking about helping companies. What do you think GPs are doing in Germany to help their portfolio companies weather the macroeconomic environment that we're seeing at the moment, which is not great?
Okay. So what I think is in the past, I would go back before the financial crisis. Private equity in Germany was mainly multiple expansion and deleverage. And since the financial crisis, private equity firms did a lot of effort in improving, working on operational improvements, so value creating in companies. And at this stage, I did talk to a couple of entrepreneurs right now, and which are also covered by private equity. And they say value creation is now getting to a critical stage. You can't really put much more pressure on cost, and you have this big issue of energy and other the supply chain and giving prices on to the consumers or to the B2Bs if you don't go to the consumers. So what you need to do now, and that's something which might be interesting, and that's exactly what you, for example, are doing, more asset-light themes. There's no that much operational improvement, but you can use platform to expand, and you buy companies. And if you have a good private equity on hand, which has a long-term perspective, you're positioned quite well.
Thank you, Marcus. Anything to add?
Yeah, obviously there's a couple of challenges. I think one challenge that also asset-light businesses have is the access to skilled labor. And I think we see a lot of flexibility really on the level of small mid-cap companies. I mean, in part, they go to exotic countries themselves, try to find people, try to teach them technical skills and language skills, instead of waiting for the state to finally find a path towards qualified immigration. And I think this is a common theme that we regularly see, that the mid-cap companies just go their own way. And then over and above lack of skilled labor, obviously, particularly industrial companies need to cope with a couple more issues. And also there, they're very flexible. I mean, if you look at a chemicals company, you need gas not only for heat, but also for the process, the chemical process, so you cannot easily substitute it. But nonetheless, even someone like BASF announced that they will be able to live with 50% of gas supply by shifting towards oil, which is unfortunately from an ESG perspective, but that's how it is, to shift towards electricity, shift production in other countries where you have a lower cost of energy, and obviously increase process efficiency to reduce your consumption. And ultimately, they will drop off particular products that are not very profitable and consume maybe overproportionately gas and other sources of energy. So with that, and even a heavy gas consumer can reduce substantially. And I think the German industry has already reduced by 20% the gas consumption without dropping production much. And I think this is the kind of flexibility that we want to see in our borrowers and that we see on a daily basis in the mid-market companies, that they take action without waiting for the state to actually put the framework right, particularly with skilled labor and energy cost. And ultimately, I mean, there you see who has pricing power and who doesn't. Those people that find a million excuses not to increase the prices now will not be the winners in the next few years. And those companies that have a strong bargaining position, they even take extra margin at the moment with increasing prices.
Thank you, Marcus. And to wrap up, we want to look ahead. So what are your thoughts for the future, Oksana?
I think, again, we can separate a little bit different strategies. We do expect volatility, actually quite a bit of volatility in the existing portfolios. I think just the mere fact that the companies are not really able to forecast and the cost controls that have always been the strengths of the German managers have kind of gone out of control, right? We'll just see that. Of course, lots of assets were purchased at very high prices, so we'll see some adjustments, prolonged time to exit. That's in the existing portfolio side. On the next wave of investments, of course, we've seen a lot of funds move more and more towards asset-light, software-heavy, software tech businesses. Fine, but economy is much bigger than that, right? So we do expect some return back to a little bit more traditional private equity, not every deal is a software deal, I guess, forward going. And in our earlier stage funds and companies, there I think we actually expect a lot of innovation. All the issues that the panel discussed today, including retraining labor force, impact investing, energy efficient investing, all of that we're expecting to see more in the earlier stages. So actually that's part we're quite excited about at the moment, and we see a lot of deal flow there.
Yeah, I think many points have been mentioned, and I think everything is worthwhile saying. I think there will be a recession next week, next week, already next year, and that the companies in Germany, if they have functioning business model, are well prepared. What the government is saying, I was laughing about it, we need to unterhaken. That means everybody's working together, and I think people are working together, entrepreneurs, employees. We have a good government. I think there will be some support from the government as well. But as Marcus said, people, companies, entrepreneurs are always already doing a lot without having government money, and to have private equity in place who can support good companies will bring us opportunities that are quite attractive. I think we are looking for interesting vintage years ahead of us in Germany and in Europe.
Absolutely. So, well, we don't have the glass ball and cannot say what will happen in the next months, but I think as the German economy has managed to evolve from all previous crises very strongly, given that we do have a strong economy in terms of debt, in terms of still in terms of inflation, and also in terms of unemployment rate, we will emerge from this volatility. A question is a bit when, but we are, I would say, cautious optimistic that next year will provide us new investment opportunities, so not only on the restructuring side, but most importantly also on profitable, fast-growing companies. As Oksana mentioned, that especially in the renewable energy space, there's so much happening right now. And also entrepreneurs, families. What we've also seen in past crises is that such a crisis always leads to thinking about de-risking the company, looking for a new partner in order to take a bit slower pace, but have a partner on board who helps to support to grow the company.
And just to add to that from a financing perspective, so we expect a slightly different composition of deal flow. So I think the classical deal flow will still persist. Private equity-backed asset-light businesses, healthcare, software, we also see no reason why this should go down dramatically. But on top of that, there will be, I would guess, more sponsorless opportunities. I mean, we've been talking about sponsorless opportunities for debt funds for quite a while. But given that banks will be very busy with their mainly industrial portfolio, and there will be big financing needs, in particular around pre-stocking and around obviously weathering the storm of maybe lower margins. I think also entrepreneurs will open up for credit funds. And it will be quite a few asks sort of on short term, more like revolving credit type facilities that funds would not typically do, and I think that could lead to innovation in the industry to also cover part of that traditional banking market, at least for a transition period. And all in all, I think there's good opportunity. Pricing, I mean, we're not seeing a lot of repricing, to be honest, on the debt market. It's maybe 25 to 50 base points. But then obviously with floating rate, we see the Euribor come up. And then I think at some point will be an interesting discussion around what's the maximum pricing that is realistic, particularly for unitranche. I mean, if you currently have a whatever 7% cash margin profile, and all of a sudden you need to add 200, maybe at the extreme 250 base points of Euribor to that, then I would guess that the ask is that there's a shift towards sort of more non-contractual terms, more equity warrant, more PIK interest instead of cash interest, because otherwise, at least during a certain period, the financing structure is not supportable. But all in all, I think good opportunity for the funds, but I think creativity in terms of structuring and also maybe in terms of structuring of the pricing is required.
Thank you. It's good to know that you're not too doom and gloom about the prospect of Germany. Thank you, everybody. And I think the room breaks for lunch now.
Just to finally close, thanks again to the panelists. I think those comments sum up really the morning that we've had, where we've heard a lot of wide-ranging comments, lots of note of caution, but also optimism about the strength of our industry and the fact that it can harness opportunity given specialization and so on. We will now break for lunch, as you mentioned, which lunch will be in the lounges and the food court. This session will resume at 2 o'clock, and Matthew Robinson of IPEM will host. I'm Leon De Bono of the BVCA. It's been a pleasure moderating this morning or chairing, and thank you to IPEM for the invitation. But enjoy your lunch. Thank you.